The closing bell rang exactly 15 minutes ago on this Friday, July 10th, 2026. S&P 500 closed at 7,571, up 0.4%. The Dow, 52,593, up 0.3, and the NDX climbed 0.3% as well.
Yeah.
So that officially marks the fourth winning week in the last 5. And we need to be really clear about this for you guys listening. If you are simply looking at those green numbers flashing on your screen and assuming a healthy tape, you're intentionally being misdirected.
Oh, totally. I mean, we are looking at a tape that is putting on, frankly, a masterclass in illusion right now. The surface-level price action suggests this confident structural breakout.
Right.
But the internal mechanics, the actual money flows we're tracking in today's institutional strategy notes, they tell a completely different story. It is extreme caution. It's defensive posturing. The smart money is not playing the game that the scoreboard suggests.
Exactly. And so today's mission is to decode that highly specialized institutional briefing. We're going through a Friday PM market update that's essentially acting as the private playbook for Wall Street's largest funds. We're looking past those closing prints.
We have to.
Yeah, and we're going to translate the complex realities of, market breadth, volatility crushes, institutional hedging into the actual actionable setups that you need for Monday.
Yeah, because if you don't understand the setup, you're just exit liquidity.
100%. I actually like to think of the S&P right now not as this booming market, but as a massive suspension bridge where, 400 of the supporting cables have completely snapped.
Wow. Yeah, that's a good way to put it.
Right. It's still standing, but only because 5 or 6 giant steel pillars right in the center are holding the entire weight. So let's look at the volume. If these indices are hitting winning streaks, why was Friday's participation some of the quietest we've seen since early July?
Well, the lack of volume is the market's tell, right? A true structural breakout, it requires volume confirmation. Heavy, aggressive buying by institutions, signaling they actually believe prices will keep rising.
Which we didn't see.
We saw the exact opposite today. Funds are keeping their powder dry because the market is locked in this classic wait-and-see holding pattern ahead of just a massive collision of economic data.
Oh, next week's calendar is an absolute minefield.
Totally. Tuesday alone, you've got the June CPI inflation print. You have Federal Reserve Chair Kevin Warsh's highly anticipated congressional testimony.
Right.
And you have the official kickoff to Q2 earnings. JP Morgan, Citigroup, Wells Fargo, they're all reporting.
So that is a wall of market-moving catalysts hitting in a single 24-hour window, which means these modest gains we saw on Friday, just drifting up to 7,571 on the S&P, those aren't the result of aggressive buying. They're just technical placeholders.
Yeah, exactly. Technical placeholders. The institutional desks, they aren't stomping on the gas pedal here. Now, they chose not to actively short the rally into the weekend, but they certainly aren't buying with conviction. They're just letting the market float on incredibly light volume.
Which makes the midday reversal we saw today so fascinating, because the notes indicate the market actually opened in the red.
Yeah, gap down.
We had fresh Middle East headline risks concerning the Strait of Hormuz, triggering some early profit-taking. But then, right in the middle of the session, we get a key reversal. The indices just flipped from red to green. So if volume is incredibly low and everyone is just waiting for Tuesday, what mechanical force actually drove that move?
Geopolitical relief. That acted as the trigger for a very, very stealthy sector rotation. Reports crossed the wire that U.S. and Iran technical talks were continuing, and that single headline caused Brent crude to stabilize. Yeah, Brent broke below $76 a barrel. And to put that in perspective, oil was recently spiking near 120 on wartime highs. So dropping below 76, it mechanically sucks the immediate inflationary premium right out of the market.
Right. It gives equities room to breathe.
Exactly.
So falling oil prices gave the institutional trading desks the perfect cover to execute what the strategy notes are calling quiet accumulation and defensive rotation. And here is where the institutional logic feels totally contradictory on the surface.
Oh, for sure.
The notes show funds aggressively trimming speculative, crowded semiconductor names. Micron and Marvell were sold down over 3%. But then capital rotated into defensive consumer staples. Walmart, Nike, Home Depot.
Which makes sense.
That makes total sense if you're being defensive. But they also bought Meta, which surged, 6.28% to over $671. And NVIDIA, which essentially lifted the entire index by rallying 3.5% to around 210.
Right.
Selling off semiconductor chips only to plow cash into Meta and NVIDIA. I mean, how is buying a high-flying AI chipmaker a defensive rotation?
It sounds crazy, right? But the key is distinguishing between a speculative crowded trade and a fortress balance sheet. In traditional finance, sure, extreme safety means moving to cash or hiding in a low volatility staple like Walmart.
Sure.
But in the 2026 market structure, extreme safety also means retreating to the most highly liquid mega-cap tech stocks in the world. Micron and Marvell, they had become overextended. The money parked there felt highly vulnerable ahead of Tuesday's CPI print.
Okay, so institutions took profits, but they didn't pull that cash out of the market entirely.
No, they parked it in NVIDIA and Meta purely because of liquidity.
So they are hiding in plain sight.
Exactly.
They buy the absolute biggest companies in the index because it's infinitely easier to liquidate those positions and get their billions of dollars back out on Tuesday morning if the inflation data comes in hot.
That's it. And with Meta specifically, there was an underlying fundamental catalyst validating that move. Analysts had flagged, lower than feared AI infrastructure spending, and Meta announced a custom AI chip partnership with Broadcom and TSMC.
Right.
But fundamentally, yeah, parking capital in NVIDIA right now is a defensive maneuver disguised as a tech rally. It lets these funds trim the risky edges of the chip sector without sparking a broader market panic.
Okay, so if institutions are hiding in plain sight by parking their cash in a handful of mega caps, what happens to the rest of the market? Because when we look at the individual stocks outside of that protective tech bubble, Friday's tape told a wildly different story.
A completely different tape.
Let's look at the blockbusters and the reversals. SK Hynix, trading under the temporary ticker SKHY. They just had a historic $26.5 billion U.S. Nasdaq debut.
Massive.
Largest U.S. listing by a foreign company ever. It priced at 149, peaked near 181, and closed up about 14% at 170. But the notes highlight a massive wave of institutional profit-taking right at the midday peak, despite the IPO being 7 times oversubscribed.
Yeah, the fast money met that blockbuster retail demand right at the open. The institutions that secured their allocations at the IPO price, they rode the initial surge of momentum and then immediately trimmed their positions into the strength.
It's basically the equivalent of a hyped-up nightclub, where the VIPs, the institutions who got in early, are quietly selling their tables to the people waiting outside just as the party starts.
That is exactly what it is.
They take their guaranteed profit, walk out the back door, and leave the retail traders holding the bag for the rest of the night.
Yep. And that dynamic, it contrasts sharply with how the options market manipulated Rackspace technology today, ticker RXT.
Oh, Rackspace was wild.
Right. It was absolutely decimated on Thursday. The stock collapsed because management slashed their fiscal year 2026 revenue guidance. The fundamental outlook was just bleak. But on Friday, the stock stages this massive V-shaped reversal, surging 22% intraday to close at 5.35.
A 22% jump one day after a severe guidance cut requires massive structural buying. Where did that flow come from?
Options traders. They aggressively bought the dip, completely ignoring the near-term revenue warning. They focused entirely on a newly announced enterprise AI framework and a strategic partnership with Palantir.
Palantir.
Yeah, it just illustrates the sheer gravitational pull of the AI narrative right now. If a company can successfully attach AI and Palantir to its ticker, speculative capital is willing to completely look past immediate fundamental weakness.
Unbelievable. But then you have a legacy company like Delta Airlines, ticker DAL, which experienced the total opposite end of the spectrum.
Oh yeah, poor Delta.
Right. Delta reported a massive $1.4 billion pre-tax profit for the June quarter. They even announced a 15% dividend hike, incredible fundamental numbers. Yet the stock faced a really choppy sell the news session.
Sweet puppy.
It slid 2.5% early in the day before eventually clawing back to close up 2.2% at $89. So for the listener, they have to be wondering, why punish a company for hitting it out of the park?
Well, the Delta price action proves how dangerous this upcoming Q2 earnings season will be. Strong execution for companies like Delta is already entirely priced into the market.
Well, anyone already knew it.
Right. Every institutional model expected them to have a record summer travel season. So when a company simply meets those sky-high expectations, funds use the initial retail buying pop as a liquidity event.
Wow.
They use the surge in volume to sell their shares to eager retail buyers. So if you're holding a stock going into earnings next week, understand that just meeting expectations is a vulnerability.
Which makes the fundamental breakout of WD-40, ticker WDFC, the rare exception here. The industrial lubricant company, not an AI company, not a tech giant, skyrocketed 25% to $294 after absolutely destroying EPS expectations. They reported 2.24 versus the expected 1.58.
Huge beat.
It's a stark reminder that when boring, legacy cash flow companies dramatically overdeliver, Wall Street will still chase them with absolute conviction.
It just proves fundamentals still dictate price discovery, provided the upside surprise is large enough to force algorithmic models to aggressively re-rate the stock's fair value.
Okay, now we need to dig into the most complex and, frankly, the most unsettling revelation in today's strategy notes: the market internals.
This is the real story.
Let's look at market breadth. The S&P closed near its highs at 7,571, but underneath the hood, decliners actually outstripped gainers today. More individual stocks went down than went up.
Yep.
Earlier in the week, we saw 9 out of the 11 S&P sectors finish in the red on a day when the overall index actually closed higher. The leadership is hyper-concentrated in AI infrastructure, specifically high bandwidth memory and custom silicon. So we have to confront a serious question here. If the major indices are hitting winning streaks, but the majority of individual stocks are falling, doesn't that break the entire concept of index investing as a quote-unquote safe, diversified strategy?
Oh, the illusion of passive diversification is actively breaking down right now. When an investor buys an S&P 500 index fund, the traditional assumption is, well, they own 500 companies equally contributing to their wealth. But the mathematical reality of a market cap-weighted index in 2026 is that your returns are being entirely dictated by a handful of custom silicon and high-bandwidth memory stocks. If a portfolio does not heavily weight the AI infrastructure supply chain, it likely lost money on Friday, regardless of what the headline index number said.
The smart money is fully aware of this fragility. Which brings us to the great volatility crush. The VIX, commonly known as the market's fear gauge, fell 6.3% today to 15.84.
Extremely low.
It's sitting at 6-month lows. And a low VIX traditionally signals a calm, complacent market, but the strategy notes point out a glaring divergence here. While the index is hitting highs and the VIX is dropping, equity-only put-call ratios have been steadily rising for over a month.
Yeah, that's the tell.
Let's quickly translate that. Puts are downside protection bets that a stock will fall. Calls are bets on the upside. If the ratio of puts to calls is steadily climbing, it means volume is heavily skewing toward downside insurance.
And we're also seeing short-term breadth oscillators flashing mechanical sell signals.
Let's explain what that oscillator is actually measuring under the hood before we tie it back to the put-call ratio.
Sure. So a breadth oscillator measures the momentum of market participation. It constantly tracks the volume of advancing stocks versus declining stocks over a specific rolling time window.
Right.
When the overall index price is pushing higher, but the oscillator slips negative, it means the upward price action is being driven by fewer and fewer stocks. It's a mechanical sell signal because the underlying support is vanishing.
So we have breadth oscillators signaling exhaustion and equity-only put-call ratios steadily rising as funds buy downside protection. Yet the VIX is at a 6-month low. How do we make sense of a market that looks completely calm on the fear gauge, but where institutions are aggressively buying up put options?
Well, we have to look at the mechanics of an implied volatility crush. Earlier, we established that dropping oil prices sucked the geopolitical fear out of the market.
Yes, the Iran-US technical talks.
Exactly. So when massive headline-driven macro fear evaporates, implied volatility across the entire options chain gets crushed. The premium that option sellers demand to take on risk shrinks dramatically.
Which makes puts cheap.
Mechanically, yes. It makes put options downside insurance incredibly cheap to purchase.
Okay, so institutional funds aren't blindly bullish just because they are parking cash in NVIDIA. They see the exact same weak breadth and fragile foundation we just discussed. But because the VIX is crushed down to 15.84, that downside insurance is just sitting on the discount rack.
That's exactly it. They are quietly buying up those cheap put options to build a defensive fortress underneath their portfolios into the close. They lack trust in the sustainability of this rally.
Because of Tuesday.
Right. If Tuesday's CPI print comes in hot, or if capital expenditure guidance from the core semiconductor giants disappoints later in the week, we could see a remarkably fast, deep correction. There simply isn't broad market support underneath the mega caps to catch the fall.
So that sets up our playbook for next week. How do we take all this hidden fragility, all this institutional hedging, and turn it into actionable levels for Monday's open? The strategy notes explicitly highlight a gamma wall.
Yes.
For the S&P 500 index, the psychological firewall is 7,500. But for the SPY, the tradable ETF, the absolute line in the sand is $745. Before we talk about what happens if 745 breaks, let's explain the physics of a gamma wall. What is actually happening between options dealers and the stock price at that specific number?
So a gamma wall is essentially a massive structural barrier built by options market makers. When retail and institutional traders buy thousands of options contracts clustered around the 745 strike price, the dealers who sold them those contracts take on immense risk.
Right, they have to hedge.
Exactly. To remain perfectly neutral and protect their own books, those dealers are forced to aggressively buy and sell the underlying SPY shares as the price moves. Because of the sheer volume of contracts expiring near 745, dealer hedging creates a localized gravitational pull. They buy when it dips below, and they sell when it pushes above, basically pinning the price against that wall.
But the notes warn that if the 745 level decisively breaks, there is a liquidity vacuum down to the 730 to 740 zone.
Right, and a liquidity vacuum means there are no structural buy orders, no institutional bids sitting in the order book between 745 and 740.
It's just air.
It's air. If the dealer hedging fails to hold the gamma wall, the price doesn't just drift down, it drops rapidly through that empty space until it finds a level where institutions are actually willing to step in and buy.
So given that Friday was a low-volume drift, the notes suggest a trend continuation on Monday is statistically unlikely. The recommended setup here is a volatility compression fakeout.
I love this setup.
Yeah, the institutional play is to expect a mean-reverting, range-bound Monday. They are looking to go long on the SPY if it sweeps down to Friday's low of 745.59 and immediately reclaims it, playing the bounce off the gamma wall. But if the SPY tries to break out higher and fails to hold 753, the strategy is to short it. The market is caught like a tightly coiled spring between cooling inflation narratives and lingering data anxiety.
And fading that initial breakout attempt on Monday morning offers a really high-reward, low-risk entry. It is the classic institutional approach to a market that is fundamentally paralyzed until Tuesday's data drops.
The notes also outline two high-conviction day two plays for individual stocks.
Yes, let's hit those.
The first is SK Hynix. On Monday, their temporary ticker transitions to the permanent SKHY. The strategy is to buy a pullback toward the 165 level, utilizing a tight stop loss below 158.
That is a very classic day two institutional allocation trade. The funds that missed the chaotic, headline-driven IPO debut on Friday, they'll look to build their core long-term positions on Monday once the retail frenzy settles down.
Assuming it hits 165.
Right, assuming the price retraces to a reasonable anchor level around that 165 mark. Correct.
Now, the second day two play is brutal, but it highlights exactly how the mechanics of Wall Street operate. Moderna, ticker mRNA. The stock crashed on Friday, dropping 10.7% to 68.39 after JP Morgan reiterated a sell rating and placed it on their top 25 list of stocks to short.
Ugly chart.
Just ugly. Despite the crash, high-volume call options surged as retail traders desperately scrambled to buy the dip. The strategy notes suggest doing the exact opposite. They frame this as a clean momentum play. Short any weak bounce under 71, targeting a complete flush down to the low 60s. Why are retail traders trying to catch this falling knife, and why do algorithmic models love to bet against them?
Well, it's a battle between human psychology and market structure. Retail traders often fall victim to price anchoring. They remember Moderna trading much higher just a few days ago, so a 10% drop intuitively feels like a bargain to them.
So they buy calls.
They buy call options, hoping for a quick, dramatic bounce back to the old price. That is the very definition of catching a falling knife.
Yeah.
Institutions, however, they do not trade on feelings. They trade on algorithmic flow and structural dynamics. When a massive Tier 1 bank like JP Morgan places a stock on a high-conviction shortlist, it triggers automated selling algorithms and forces portfolio reallocations across multiple funds.
And that structural selling pressure doesn't just evaporate overnight because it's a new trading session.
Exactly the opposite. The institutional algorithms expect retail traders to buy the Monday morning dip. That brief, desperate spike in retail buying provides the exact liquidity the institutions need.
They use it to short.
Yeah, they use it to initiate new short positions at a slightly higher, more favorable price around 71 before aggressively driving the stock down to its structural floor in the low 60s. They literally use retail optimism as the entry liquidity for their short positions.
They turn the retail traders into the exit liquidity. Man, we have covered a massive amount of ground in this deep dive. We stripped away the illusion of a quiet Green Friday closing print to reveal a market structurally held up by a handful of AI giants. We examined how the smart money used the cover of dropping oil prices to silently build a fortress of defensive hedges, capitalizing on a crushed VIX to buy cheap downside insurance ahead of a monumental collision of economic data this coming Tuesday.
The surface numbers demand complacency, but the internal tape reveals a highly concentrated, structurally fragile environment where the largest funds are aggressively positioning for turbulence.
Which brings me to a final thought I want to leave you with as you prepare your screens for Monday's open. If passive index funds are increasingly functioning as nothing more than wrappers for a few highly correlated AI infrastructure and custom silicon companies, have passive diversified investors unknowingly transformed into sector-specific speculators?
That is the question.
When the mathematical safety of the herd becomes an illusion, how resilient is your own portfolio to a microshock in the semiconductor supply chain? Next time you see a calm green market on your screen, remember the dynamics of the gamma wall and the put-call divergences. Enjoy the surface-level performance, but never stop asking what the other hand is doing in the shadows.